one of the great success stories of 20th century university is the business school. And of course, the underlying reason for that is the continuous growth in demand for business education. But then quite a number of these business schools also decided that they have additional opportunities to grow and generate more profit. So for example, the Harvard Business School, which started in 1908, by 1922 published the first Harvard Business Review and continued to grow this publishing business. In 2010, in fact, while the MBA program generated revenues of 93 million US dollars, executive education generated 112 million US dollar, the publishing arm generated 135 million US dollars. So that initial new activity in fact made the most money for the school. This consideration of growing into activities that are somewhat similar, where you can use some of the knowledge and insights that you have from the past business, is the underlying logic of most of the diversification moves that companies make. When we look at the relationship between performance and level of diversification, being low here and high here, we can see that in general we find a relationship that looks somewhat like a inverted U-shaped curve. What's happening is basically that companies are able to enter new activities up to a certain point where they can leverage the resources, the capabilities that they already have. In other words, they can use all the knowledge they have and use it in a new business opportunity. When they reach a certain point, the complexity of their business is so big that in fact the complexity costs are outshining the potential opportunities to use some of the knowledge. In addition, in fact, as activities becoming further and further removed from what they initially started off, it will be harder for them to leverage some of their insights. There's exceptions to that. So particularly when we look at the same framework here, performance and level of diversification being low and high here again, in developing countries, in emerging economies, then it tends to look more like that. The reason is that in developing countries we have more growth opportunities. So in fact, even though you might enter a new activity, the field is going to be less crowded than you can expect in the developing world. The second reason is the development of financial markets. In other words, when you have a business that generates a lot of money, you can use this money to start new activities, and even though other companies might be better, technically better, in doing this new business, they might not have the cash to do so. Access to finances is much more difficult in emerging economies with less of an angel investors, venture capitalist kind of field, and more difficulty to enter the stock exchange. So access to financial capital makes it possible for some of these large conglomerates to be very profitable, even in activities that seem very far removed from their core. And finally, political connections tend to play an even bigger role in developing countries than in the Western world. Well, when you think of many of the contracts being awarded by the government, well, if you know the right officials in government, you are more likely to get the contracts. and therefore being active across a wide span of activities might make a lot of sense. So now, keeping this sort of basic logic in mind, that diversification can be beneficial, but probably up to a certain point, with some factors in some economies suggesting that further levels of higher levels of diversification make sense. Bearing that in mind, how do you figure out in which businesses you really want to be active? So one way to do that is using the BCG matrix. This is a matrix developed by the Boston Consulting Group, where they look at the different businesses, activities that the company has from two different perspectives. So one thing they look at is the market share that a particular activity that you have in your firm has overall for this particular product category or service category that you serve. And that can either be high or it can be low. And the second aspect they look at is market growth. Again, either that can be high or it can be low. Obviously, if you are having an activity and business that has both high market growth and you have a high market share in that activity, that's fantastic. These are your stars, and you certainly want to continue investing in them and try to grow them further. If you have a high market share, but the market growth, because this is a mature industry, is not so big, then this is one of your cash cows. And you probably still want to continue being active in this area because it generates a lot of cash for you. Then the opposite from your high growth and high market share box here would be when you have a low market share and the market growth is very low. These are your dogs and you want to get out of these activities. And finally, you might have activities where your market share is low, but the growth rate is quite high. These are your question marks, where it depends on what you can actually do in order to maybe grow the market share higher to make this an attractive proposition for you. So this is one way for you to decide in which activities you want to be. I think an even better one is if you ask yourself three basic questions. You will ask, first of all, how attractive is a particular industry or activity? So you have an attractiveness test here. And if this is a very attractive market, in other words, if it meets the high market growth and high market share criteria, that's a positive one. Secondly, you want to look at the cost of entry test. If you're not yet active in this particular industry, well, then you know how much will it cost you to enter this particular industry. Are there particular industry barriers in place that are hard to overcome, make it impossible for you to enter? So say, for example, oil industry, highly attractive industry at the moment. Nonetheless, for most of us, we don't have the capital, we don't have the technology knowledge, we don't have the political connections to make this a viable option. Cost of entry test not met. But if we meet this test, then fantastic. If there is an activity where we think of getting rid of it, then we would call this a cost of exit test. Because likewise, exiting a particular industry might be costly, and we need to consider that when we want to divest a particular activity. And finally, we have to do a better off test. Are we better off by being in this industry? Are we able to bring something to the table that can gain us competitive advantage? In other words, do we have resources and capabilities that will allow us to successfully compete in a particular industry? If we meet this criteria, again, it's a yes.